Right here in the news biz, we call the top of the show the lead. And the lead today is that question, because the question that everybody's asking is very simple. If bond yields continue to rise, will stocks fall? If you go back just 25 years, you can see the green is the 10-year Treasury yield. And we all know what's happened the last 15 so years. We've seen a pretty consistent drop in yields. Stock market's been all over the place. We had diverged back in the 90s. We're diverging again the last couple of years. But in the last middle, say, 10 years, we kind of rode on together. So the question again, if bond yields rise more than they are now, will stocks automatically fall? Let us ask someone who should know, and that is PIMCO's Bill Gross. Bill, it is a simple question that is roughly valued at $1 trillion, so I give it to you. You can take X in the center square, American History for 800, or this one. What say you? What's going to happen?
Well, let me answer it by going to your chart, Brian. What your chart really shows is the history of inflation, right, and central bank responses to it, culminating with double-digit inflation in the early 80s and Chairman Paul Volcker's response to it with very tight money. Right now, central banks are responding with excessive ease, which are distorting yields to the downside, and inflation is low. And so to answer your question on the chart, the normal bond yield for the next few years, I think, should be the yield that existed for 100 years until the mid-1970s, somewhere between 2 and 3%. But demographic influences and QE check writing in the trillions, pose a risk in 2016 and beyond.
Between 2 and 3% that you just highlighted there, Bill, can stocks still rise? And at what point does the yield have to get to that might start to eat into stocks? Or does that really depend on what's going on in the macroeconomic environment?
Well, another good question, Mandy. We talked about this morning with our client conference, Mohammed and I, to 2,000 clients. The correlation between stocks and bonds up until 2008, layman, quantitative easing, was a negative one, in which, when bond prices went down, stock prices went up, at least as a reflection of real growth, until the point where it sort of got squeezed. Since 2008, with quantitative easing, not much of a correlation. But going forward, and this is probably something that Rick would probably agree with, going forward, there's going to be a mild positive correlation. If bond prices go down, stock prices should go down as well. And that's simply because the global levered trade, is dependent upon a stable Japanese yen and a stable JGB yield and a stable, Treasury yield. And once you produce instability, then that leverage starts to unwind. The housing market gets affected and stocks come down.
Okay, so I promised our viewers, Bill, a 100-year look on yields, and that is what we're going to show them right now. And again, it's a very simple question. Because if I only look back at 30 years, which we're highlighting, right, in the 10-year yield, I could say that today's rates are abnormally, unhistorically low. But if we extend the chart out all the way pre-1900, you could see that maybe 2 to 5% range is not abnormal. So my question again, is this the anomaly, or was 1980 the anomaly? Is this sustainable at this level or near it?
1980 was certainly an anomaly because Volcker was tightening the noose, so to speak, and inflation was in double digits. Is today an anomaly on the other side, on the downside? Certainly, because central banks are printing checks in the trillions of dollars and inflation is, perhaps abnormally low. That suggested, to me and to PIMCO, perhaps a month ago, that the bond bull market was over, but yet the bond bear market has not really begun. Certainly we've seen that in the last few weeks, but we think that Treasury yields, the 5-year Treasury at 1% today, the 10-year Treasury, as Rick mentioned, at 2.14%, that there's some stability there based upon continued check writing by the Federal Reserve and by the Bank of Japan. It's a big push.
I'm just going to throw something out there, Bill, and I'd like to get your reaction to it. Is it possible, or is it too much of a stretch to suggest that the Treasury market right now, and mortgage rates and everything around it, are all basically acting now exactly as Bernanke hoped? Last week he was talking about the tapering, and now we're starting to see the adjustment in the market, so that we don't get a massive dislocation, a bad adjustment, when the actual tapering occurs.
Well, I think there's something to that. I mean, he did in questions and answers, suggest that in the next few meetings, there was the potential for a tapering if employment continued to improve. This morning, President Rosengren, suggested that he would need at least 2 or 3 more months of steady improvement. So the potential for improvement is certainly there. What Chairman Bernanke wants to do is, yes, moderate the markets, but I don't think he wants a 40 to 50 basis point increase in 10-year yields, because that does threaten housing markets, that does threaten the stock market, and certainly the volatility of the JGB market over in Tokyo. When you add that to the mix, those two are a dangerous, potent combination.
With all due respect to my esteemed colleague here, Bill, I take a different tact, and I have a question for you about Ben Bernanke. Has he lost control? Because the bond vigilantes, while not as powerful as they used to be and like on the back burner now for a better part of 5 years because you can't fight the Fed, they seem to be rearing their heads like out of a whack-a-mole machine. Do you think the bond vigilantes are going to be able to move this market where they want to go regardless of what Bernanke says or the central bank does?
Well, to answer your first point about losing control, I think Bernanke has lost a little control in terms of the real economy. As a matter of fact, he never had it. And to the extent that low interest rates, reduce savings and therefore reduce consumption, to the extent that they reduce the return on investment for corporations, to the extent that they destroy business models and then, technically, sort of jam up the repo market, he sort of lost control in terms of real economic growth going forward. What do the vigilantes have to say about this? I think they're sort of down the list. First of all, the Fed and the BOJ and others, they write trillions of checks. They buy trillions of treasuries. And so, what a PIMCO or what a competitive company would do in terms of the bond market, skinny at the margin. So, the vigilantes can be vigilant, and hopefully we are and will be, but it's up to the central banks in terms of tapering or not tapering going forward.
How much of it is just a communication problem, or maybe over-communicating? Because this whole we're the big new transparent Fed means that there's a million voices coming in, not just Bernanke's, but other Fed members, to the point where the market is kind of confused.
Well, I think they are, and perhaps as you pointed out, that's part of the plan, so to speak, going forward, to confuse investors so that yields gradually move higher. I just think that they've confused markets, too substantially, so to speak. We're basically operating in unfettered territory here in terms of where the Fed is going with its tapering, where the BOJ is going in terms of its buying, where basically inflation targeting and policy response is going in the next few years. And so, there's a point going forward in the next few weeks and the next few months where central banks need to take control and reduce volatility as opposed to increase it, which is what they've done. Very quickly, come January next year, who do you think could do a better job than Bernanke?
Bill Gross?
Oh, goodness, no.
Mohammed El-Arian? Tony Crescenzi? Need I continue?
Certainly Mohammed, but Mohammed's well placed in Newport Beach. I would suggest that Bernanke has a chance to succeed himself, and there are likely successors. What I would like to see is a Fed chairman that begins to place an emphasis on savings and savers as opposed to Wall Street and borrowers. And so any candidate that fulfilled that potential would be a good candidate, in my opinion. I think UBS is putting about a 20% odds of Bernanke staying in the job. Thank you so much to PIMCO's Bill Gross. You're welcome.